So you're tired of losing trades. Maybe you get into a trade and immediately price moves opposite your direction, hits your stop loss. Keep asking yourself, maybe the market makers are watching every move you make. That's not the case. So in the following couple of videos, I'll start a course on price action. Make sure you watch each and every one of them. It's going to be very important in trading your day-to-day money, because trading without knowledge and good strategies is going to definitely lose you money and be detrimental to your mental health. So buckle up, have your trading notebook with you, and take notes. So the first lesson is going to be risk management, and under risk management there are going to be three things I'll go over. I'll go over different types of risk, different types of stop losses, and where you'll put them. So under different type of risk, there will be static risk and dynamic risk. Second, I'll go over where exactly you put your stop losses and how you manage your stop losses, whether to move them in profit or move them behind or something of the sort. Three, I'll talk of how to reduce your losses. So many of you are stuck in the break-even stage of trading, where you have a good strategy but you can't understand why your account isn't compounding. So on that third point, you're going to understand how to reduce your losses. Without further ado, let's dive right into it. Okay, so with static risk, you're going to start with static risk. So I know you're wondering what is static risk, and static risk is basically the exact same way a majority of traders place the stop loss, in that if you have a position, you'll risk 1% of your account. Okay, so let's assume you have $1,000 account, and 1% of $1,000 is $10. Okay, so let me just take an example of a trade, not necessarily a trade anyone would take, but let me just use this as an example. Price breaks below this support and you have a short position, right? So you risk 1% of your account. You're not going to go over the lot sizes because you need a position size calculator to help you determine the amount of lots you're going to input in your trade. Okay, so giving you the amount of lot size won't make any sense, because your stop loss will always be different, maybe 10 pips, 13 pips, 15 pips, and with that your lots are going to change. So let's just use this abstract example on how you're going to manage using static risk. So in static risk, you have this red part here is 1% or $10, and you're looking to make a 1 to 3. So you're risking 1% to make 3%, risking $10 to make $30 for every dollar you put into the market. Okay, so you enter the trade, price moves into a direction, and you're like, wow, I'm making profit. So that's basically static risk. Nothing more to it. Most of the time I use static risk. So let's go over dynamic risk, and this is where you break down your trades into smaller and smaller trades. And one thing I want to tell you is that you should always be okay with how much money you're going to lose, because, and I'll take my time, write this down, always be okay with the amount of money you're going to lose in each trade, because that takes a very important part, a very significant part of your psychology. In that, if you risk $10, just assume you bought coffee or something. Just don't spend your whole day blaming the market on losing $10. Enough with that. Let's talk about dynamic risk. So in dynamic risk, the same $1,000 account, let's say for each trade you risk 2%, right? But in dynamic risk, you're not going to enter immediately with this 2%. For instance, you could break down this risk into two portions. First portion, you're going to enter. Remember, the trade idea is the same, but the first entry, you're going to enter at 1%. Second entry, you're going to enter another 1%. So that's on breaking, if you've broken the trade down into two trades. Alright, so let me use a better example, which is over here. Most of you also know this setup because price makes a low. 80% of the time, price is going to retest a low that it's made. So this will be the best example to use. So, okay, price made a low, then came back up, retraced, closed bearish, and you want to have your trade over here. Also remember some other. Alright, so you have your stop loss right over there, and your target is here. This is your first target. It's a 1-to-1, but it's a win nevertheless. So remember, it's never about how big your stop loss is, but always about where your stop loss is. Whenever you enter trade using price action, you always want to have your stop loss above the previous candle. So in our case, price closed bearish, and we're going to have our stop loss above the previous candle for around 20 pips, and I take profit down here. Okay, so with dynamic risk, the first entry will be immediately the candle opens, you're going to enter 1%. And many a times price has to make a top wick before it drops down. So as long as it doesn't break the previous high, the trade idea is solid. So when price retraces, you're going to have maybe a second entry. So price came up, then you realize it's not going to break this high and it's retracing, so you enter the second percent here. So let me just highlight this and this. So over here we have our first entry at 1%, second entry 1%. Hope you can see this. So this is the same 2% you're risking, but here you're going to have the same stop loss. So basically you're having better price for this second trade. And that's dynamic risk. Fundamentally, this is what dynamic risk is all about. Enter the first trade when candle open, and when it retraces and realize it's not going to break, you enter a second trade. Also, another situation is maybe you enter the trade, it hits your stop loss. So how much are you going to lose? It's 1%, and you had initially planned to risk 2%, but you only lose 1%. So the thing is, with the static risk, you're using complete risk, and you're going to manage risk differently. I'm going to talk about that maybe in the next video on how you cut your losses short. But in dynamic risk, you're already managing risk before you enter the trade. Okay, so let me use another last example on dynamic risk to make sure that you have a grasp on what dynamic risk is. So this was an example using 2% and breaking it down into 4 trades or 2 trades. So now you're going to talk about how to break it down into 4 trades. So same $1,000 account. total risk is 2%. But with dynamic risk, you're going to enter 4 trades, each 0.5%. Right? So let's see how you could have broken this trade into 4 different trades. Trade 1 at the entry. Okay, let me push this higher. Trade 1 at the entry. Trade 2 retracement at around here. Trade 3, maybe price moves so far up it's almost, but price starts moving down, you enter that third trade. And the fourth trade is always going to be at the break of the previous candle's low, right? So each of these lines represents a trade, 0.5 risk. So imagine you entered 0.5% and price immediately shoots up, hit your stop loss. You're losing only 0.5%. But initially you had planned to risk 2%. So with dynamic risk, you're already managing risk even before you enter a trade. So that's what makes it more superior and advanced concept in risk management. I hope you've learned something in this first lesson, and if you have any questions, don't mind leaving a comment. You could maybe message me on my Telegram or Instagram. I'll be happy to help. So with that, let's end this video. Hope you have a nice trading day. See you next time.